And the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever cared what was under the damn curve? I mean, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see, it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well.
That was Peter Lynch back in 1994, Peter Lynch being one of the greatest stock investors of all time. And also the author of this book, I think it's behind me, right under Elon there. He wrote the book One Up on Wall Street, as well as a couple others, but it's a very good book for kind of basics of stock market investing. But in general, he has provided a wealth of investing wisdom, both during his career as an active investor and now since he's retired from heading the Magellan Fund at Fidelity. But one of Peter Lynch's most well-articulated ideas is this idea of having the stomach to invest, and that the stomach is really the most powerful organ when it comes to being a successful investor or not. But what exactly does he mean by this idea, and what can we learn from it? But before I get into that, if you're new to the channel, my name is Jack Duffley. I'm a real estate attorney and investor, and if you end up liking this video, definitely hit that like button below and subscribe for more content, since I put out new videos every single week. I also do quite a bit of stock content, hence the reason I came across Peter Lynch, and these ideas certainly can apply well beyond just stock investing, so thought we'd take some time to talk about this one. So what does Peter Lynch really mean by having a strong enough stomach to invest in stocks or really invest in anything? What he means by this is being able to stomach or sort of work through the volatility of holding on to a particular asset and allowing your thesis to play out over the long term. And unfortunately, most people, especially when they invest in things like stocks, do not have the stomach to successfully invest in them. That's why average returns for active investors or retail investors tend to be quite low, at least compared to the broader market. They might pile into a stock because they don't have the stomach to avoid that sort of fear of missing out, and they're tempted to buy a stock as it runs up in price, no matter what the fundamentals say it really should be worth. And then shortly thereafter, at the first sight of trouble in many cases, as soon as the stock goes down a bit, that same person might end up selling the stock, so they sell it at a loss, and then they miss out on any future gains if it actually was a good investment in the first place. I don't think anyone had a better perspective on this sort of thing than Peter Lynch, because during his tenure as the head of the Magellan Fund, which he ran for about a decade, it had some of the highest returns ever for any fund. I think it was something like an average of 30% per year or something just insane like that. So the fund on average over that decade returned something like 30% per year, but the average investor in that fund lost money. That's right, not just underperforming the fund, but literally lost money in their time in investing in the fund, because for the same reasons that we just discussed, a lot of people will buy into a stock, or in this case a fund, after it's run up a bit, and then as soon as it starts going down, they will then sell out towards the bottom, or at least below what they actually bought it for, because they're scared of future losses. They weren't scared of those future losses when they actually bought into the thing, because they had the fear of missing out on future gains. And in that way, they don't really have the stomach to invest in stocks successfully. That's really what Peter Lynch is getting at here. And an investor just bought into the Magellan Fund and held for 10 years, they'd be averaging that 30% clip per year. But instead, what they got was negative returns in many cases, because they were buying high and selling low, the exact opposite of what you would like to do and what everyone thinks they're actually trying to do, but that's exactly what happens. And this kind of goes to that return on brain damage idea I talked about a while back, where there is sort of a stress value to things when you're investing in them, and especially with stocks, which tend to be quite volatile, especially individual stocks that can really fluctuate in price pretty violently in a very short period of time. There is a stress to that, and a lot of people don't have the stomach to actually get through that stress, because it can be quite stressful. You can see all of your investment gains over a year get wiped out in a matter of weeks, which many investors have seen, myself included, pretty recently. I actually went negative on my stock portfolio for the first time in the past couple of years. We're back up to positive because we had a pretty significant rebound, at least as of filming this. We'll see what happens this week. That's the nature of the game with stocks especially, but really any investment. There's going to be volatility. The value, or really the price of the thing that people are willing to pay for that thing, is going to fluctuate pretty wildly in many cases, because there are lots of emotional people out there. That's the average investor, as we've already talked about. The average investor will buy on emotion. They'll buy high, sell low for whatever reason, because they have a fear of missing out, and then they also have a fear of losses once they're actually in the thing. And I suppose it's because investing is a very unnatural thing. It's really going against what our human intuition might be, which would be to take what we can now and don't lose that thing. So just kind of preserve it, take it, consume it, whatever it is. The idea of preserving something for the long term in such an uncertain world is very scary. And it seems quite against what our natural inclinations can be. And building that discipline, that stomach muscle, I suppose you could say, that isn't easy to do. And some people are born with a greater propensity to be able to do that, but a lot of people aren't. And if you can find a way to improve that sort of discipline, which again is very hard to do, especially without experience and making mistakes, it's going to be really hard to actually get anywhere when it comes to stock investing, active investing, really investing in anything, or at least in anything that really requires you to hold it for the long term to see consistent reward. But if you can be one of those people who has the discipline to hold through market downturns, who also has the discipline on their own personal financial side where they're not spending more than you're making and you're constantly bringing in new money every single month from ideally a variety of sources, but at least one decent source so you can keep improving, that's going to get you a long way. And if you can keep putting that money to work and putting it into quality assets that you hold for the long term and not selling at the first sight of trouble, that's probably going to bode pretty well over the long term. But I think one reason that so many people don't have the stomach to invest in things, at least for the long term, is because they are investing with money that they can't afford to lose, or that they really just can't picture losing at all. So as soon as you see some negative volatility, all of a sudden people want to take that money out of whatever that investment is. They're scared of losing more because it's not money they can lose. And that's not a very effective way to invest. One thing I've noticed with a lot of investors, and something that I try to do as well, is looking at the investment money as almost lost money. It's not money that I need tomorrow. And if it really is, that means that things are going really poorly because I have some emergency funds ready to go. I can pull out debt from credit cards in an absolute worst case scenario. And there are lots of ways that I could potentially pull money out without having to touch my actual investments. And when I can do that, I can let the investments do what they're going to do, which sometimes will be very bad in the short term and other times will be great. And as long as you let that play out over the long term, you should be in a pretty decent position. Again, assuming you're buying things at a decent price and you're consistently investing over the long term. I'm saying long term a lot in this video, which I don't think is a coincidence. You could almost call your stomach your short term sort of indicator for what to invest or not invest in or what to sell, whereas your brain is sort of that long term, more rational sort of instrument that allows you to hold on to things and sets out that plan that then your stomach tries to throw off course for whatever reason. If you can find a way to control your stomach, or at least get it strong enough to get through some of that pretty intense volatility that you'll often see and understand what your actual long-term thesis is, get that logical brain back in front of your stomach, then again, you're probably going to be in a decent position. But this is way easier said than done, especially if you haven't been through a serious crash before. I've certainly seen some volatility while I've been investing, but nothing compared to some of the worst crashes in history. I mean, even back in March of 2020, when I was just really starting to ramp up my investing, I saw some pretty significant volatility, but now that my portfolio was much bigger than it was then, it's going to sting a lot more in the short term to see a crash like that happen again. But I keep reminding myself that something like that is probably going to happen at some point before I die. And throughout my life, I'm going to have money tied up in investments. So it's going to happen at some point. That's something that Peter Lynch has talked about a number of times as well. The stock market is going to go down sometimes, so you have to be ready for that. And this really pairs with the idea of the stomach being the most important organ when it comes to investing. And that investing really does not have to be all that complicated. There are a lot of relatively simple investing strategies that don't require complex sort of formulas or whatever. You can really get pretty far with a simple investing strategy and the discipline and the stomach to get through things. And overall, I think the first step is to acknowledge that your stomach is a thing and you got to be ready to control it as best you can, or maybe ignore it, whatever the actual metaphor would be. You want to make sure that you're ready for these volatile times, or the times that might be pretty stressful, where you might be tempted to sell or tempted to pile in onto some speculative hype stock or whatever it is. You have to be ready for those moments and ready to not act on those stomach churning incidents that would otherwise cause you to commit some pretty bad financial moves. The stomach is often the first and last line of defense to get to those money-making activities and to avoid those money-losing activities. So thank you, Peter Lynch, for that one, and tread carefully out there, everyone. If you like this video, definitely like it and be sure to subscribe. Check out the affiliate links in the description below as well. But until next time, take care.